Hello and welcome to Quarterly Perspectives, second quarter 2018. My name is Jonathan Scheid, and I serve as the Vice President of Portfolio Strategy and Education at Loring Ward, and I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset class performance, and the second part looks at recent market and economic headlines. We start our performance discussion with a high-level look at a collection of major asset classes. As we can see from this illustration, U.S. stocks performed the best of the group during the quarter. International stocks declined slightly, and emerging markets struggled as the U.S. dollar increased. When we look at bonds, interest rates rose in the U.S., and that sent U.S. bond market prices lower. In reviewing the U.S. and international size and style premiums, we can see a few trends. In the U.S., small stocks outpaced large stocks in every style category. In developed international markets, growth stocks outperformed value stocks in every size category. When we take a longer perspective and look back at the last 15 years, we can see that small stocks outperformed large stocks in the U.S. And that tilt towards small company stocks versus large company stocks has rewarded investors with a 15-year annual premium of 1% on average. From a style perspective, value stocks underperformed growth stocks with the 15-year annual difference of negative 0.9% on average. When we look at the last 15 years for international stocks, investors tilted towards small companies experienced a 3.5% annual advantage over large stocks, while small company stocks suffered a minus 0.1% disadvantage versus growth company stocks. This is an important reminder that the premiums we expect to receive from value companies and small companies in the U.S. and abroad are not guaranteed, and this is why we feel it is wise to have multiple factors of return in our portfolios at all times. When we look at year-to-date returns for the asset classes in our portfolios, we see asset classes ranging from a positive 7.7% for U.S. small capitalization companies on the high end to a negative 7.5% for emerging market value companies on the low end. Maintaining a diversified asset mix such as a 65% stock, 35% bond mix shown in white kept you away from the more extreme returns from year to year with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in your portfolio. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. The overall return on this index mix for the second quarter was a positive 0.95%. We can see that the three international stock components were detractors from the performance, while all U.S. asset classes presented added to the overall return of the portfolio this quarter. This chart highlights the benefit of owning multiple asset classes in your portfolios. Let's now turn our attention to some of the major stories we saw in the second quarter. Here's a graph of world stock market performance during the quarter, along with some noteworthy headlines. As we can see, new information comes out daily, potentially impacting the direction of individual companies and the overall market. While this collection of headlines isn't meant to explain why the global stock market returned what it returned, we present it to help illustrate that there is a lot of short-term news that may tempt us to make investment decisions we may regret. Therefore, it is wise to stay informed, but we feel it is important to keep a long-term perspective when it comes to investing. We note one recurring headline that dominated the news in the second quarter, and that was related to trade. The topic of trade has been in the headlines because the Trump administration is trying to revise a number of their trade relationships. While the media has been quick to label this a trade war, we feel it is important to use proper labels when discussing the topic of trade. Given the total size of new tariffs issued to date, we feel it is better to describe the current state of trade policy as a trade negotiation rather than a trade war. Earlier this year, the Trump administration outlined what it believes is important about trade. They want it to be free, fair, and reciprocal. They highlighted a number of initiatives to help frame their desired outcome from their trade negotiations. From modernizing the North American Free Trade Agreement to seeking to enforce World Trade Organization rules, the Trump administration is negotiating in a variety of ways. Trade deficits get a lot of attention from the Trump administration and the news. A trade deficit occurs when one country buys more goods from a country than it sells to that country. The country with the largest trade deficit with the United States is China, and that deficit has only widened over the past decade. This trade deficit stems from the fact that China can generally make goods at a lower cost than the U.S. can. This has benefited U.S. consumers as it has helped keep inflation low and allowed for more cost-effective innovation. On the flip side, a good made in China means that it isn't made in the U.S., and that potentially means we have less jobs. In an effort to reduce the trade deficit the U.S. has with China, the Trump administration is imposing tariffs on Chinese imported goods to get China to the negotiation table. Tariffs are a tax on imported goods and services, and China has responded to the new U.S. tariffs by issuing its own tariffs. While the talk of tariffs makes a great headline, the idea of tariffs is not new. In fact, we've been living in a world full of them for a very long time. The U.S. actually has very low tariffs on imported goods, but the same can't be said for our trading partners. When the U.S. and other nations try to send goods and services to other countries, the tariff tax is much, much higher. On average, China charges almost 3 times as much as the U.S. does on imported goods, and the European Union charges almost 50% more than the U.S. does on imported goods. This makes foreign goods, like the ones made in the U.S., more expensive to consumers and businesses in China and the European Union. As we can imagine, the Trump administration's desire for free trade would mean that these costs go down or be eliminated altogether. This may make U.S. goods and services more reasonably priced and therefore more desirable in foreign lands. So where do trade negotiations go from here? The honest answer is we don't know, and it isn't clear how long these negotiations will continue. We know that trade negotiations are happening with many countries and many trading regions, yet the only completed negotiation we know of to date is with South Korea. South Korea is a sizable exporter of steel to the U.S. When the Trump administration announced a 25% tariff on steel imports, South Korea was quick to negotiate an updated trade agreement. As we can see from the terms of the new trade deal, exports from the U.S. will increase, but several existing structures will continue. From an investment perspective, these negotiations may turn out to just be more investment noise. The good news is that we have a broad-based investment strategy where we invest in over 10,000 companies from over 45 countries. This global diversification may help reduce the potential impact of trade negotiations with a specific country, or the potential disruption tariffs may cause to a specific industry. As we can see, diversification remains our friend. This concludes our presentation for today. Thank you for joining me. To review this and past commentary, please see Loring Ward's YouTube channel. Thank you.